you listen to me, you may buy into my concepts, but then here's what's going to happen to you. You're going to go home. And you're going to go home and you might decide to share some of these concepts with other people in your life. And when you do, you're going to get a reaction. The reaction from some of those people might be, no, honey, get a job. And what I want you to understand is if other people react to you that way, you cannot blame them. And the reason you cannot blame them is because our society is constantly bombarding all of us with this idea that we have to be safe and secure. Constantly. In fact, I just want to take you back to the last probably 20 years of political elections, other than the last one, okay? In the last 20 years of political elections, one of the issues that used to be talked about a lot before the war, what they talked about a lot was this issue of something we all get to look forward to when we retire. They wanted to take this money and put it in something called a lockbox, which nobody knows what that means, so that it's not touched. It's something we get to look forward to when we retire. It's called Social Security. Big issue. Would you agree? Well, watch this. Can anybody in this room tell me what is the maximum per month you can draw on Social Security if you're going to retire today in today's dollars? It's about $1,500 a month. That's about the max, about $1,500 a month. Can you tell me what your lifestyle is going to be if your sole source of income when you retire is $1,500 a month? I know what some of you are thinking. Better than what you have now, right? Great, go for it. Or think about this. Banks advertise, put your money in the bank, it will be safe and secure. Do a ton of people put their money in the bank for safety and security? Yeah, what do they get on their money now? 2, maybe 3%? Or my absolute favorite one is the insurance industry. The insurance industry only sells one thing. It sells security. People rush out and buy insurance. If it's not required by law, they rush to buy insurance because they're so afraid of losing their stuff. Okay, now I'm going to teach you something that's really valuable. Tonight when you get home, I want all of you to do something. I want you to take just a few minutes and observe all the stuff you've accumulated in your life. And as you're looking at your stuff, I want you to ask yourself this question. Is there anybody else out there who wants my stuff? And by the way, if you ask it seriously, here's what will happen. You'll be looking at some of your stuff saying, heck, I don't even want it anymore. Yet we're so afraid it's going to burn up, someone's going to steal it, we're going to lose it. Gang, did you know that if you lost all the stuff that you treasure today, you can get more? It's just stuff. And by the way, you know what amazes me? Not only can you get more, but the more that you get is generally better than the stuff that you had anyway. Yet people are so focused on their stuff. And if you don't buy this, think about this a second. Would you agree there are people who will not make positive, life-changing decisions because of the fear of losing their stuff? In other words, their thought process says, I can't do this because if I do this, somebody's going to come and take my car, take my house, take my stuff, and I won't have any of my stuff anymore. Isn't that true? Well, if you ever feel that way, then you need to understand something. You no longer own your stuff. And this is a cliche, but what's the reality? Your stuff now owns you. And are there people, literally, where their stuff owns them? All right. Easy to talk about, difficult to do, but now I want to make a point. These 4 things I just took you through, would you agree it's all a thought process? Just the way you think. And would you agree that people reach certain levels of wealth based on their thinking? Would you agree with that? Okay, so all I tried to do in this first 4 concepts here is to teach you concepts about thinking. Now I'm going to get to what you must do, actually do. And here it goes. Number 5. You need to understand the difference between bad debt and good debt and avoid all bad. Okay, got good and bad debt up here. Let's start with bad debt. Anybody in this room tell me what bad debt is?
Credit cards.
Okay, credit cards are the most common vehicle for bad debt. I don't want that. I want to know the definition of bad debt.
Anything that depreciates.
Okay, and I want to take it one step further. I agree with that. It's debt that whenever you borrow money, you buy anything that's not going up in value, it's going down in value. In other words, bad debt is when you buy anything that's a depreciating asset that's losing value. And would you agree that our society is obsessed with this? Would you agree that our society promotes this? Would you agree that our society sucks people in to do this? In fact, watch this. Here's my evidence. Here I am. I'm sitting at home one day, and I'm watching my little 27-inch TV. I was over at my buddy's house last week, and I watched the football game. He had a 62-inch plasma LCD TV with high definition, and I thought, wow, that is cool. It's now Sunday, and I'm watching my 27-inch TV, but I get the Sunday paper, and I look through the ads, and here's a Best Buy ad that says, I can have a 62-inch plasma TV with no money down and no payments for up to 1 year. You know what goes on in my head? I say, wow, I qualify, because I have no money to put down and I can't afford payments. Then what do I do next? I jump in my car, drive to the Best Buys of the world. I look at that TV because it's right in the center when you walk in the front door. And sure enough, it's the same type of TV that I always wanted. And all I have to do is sign some papers and they'll deliver that TV? Yeah. So what do? I sign the papers, they deliver the TV. My thought process says this. I don't need the money now. I've got a whole year to come up with the money. I'll come up with the money a whole year from now. That's the way I think. However, the reality is if I don't have the money now, tell me what's going to happen a year from now. I'm not going to have the money. Therefore, at that time, I'm going to now have to start making payments, which are probably, in most cases, going to include interest from what date? The date I bought it and what rates? The highest rates in the state. In some states, it's all the way up to 33% interest. In Minnesota, it's 21.96% is the maximum. And do you know that the finance companies that set up those programs, like with the Best Buys of the world, you know what they know? Over 90% of the people that buy with zero down and no payments end up making payments. Over 90%. Are those money makers for those finance companies? Okay, so here's what I'm trying to teach you. I realize when I'm teaching 60, 70, 80 people in this room about bad debt, that some of you right now are sitting on bad debt. Here's what you need to do to get your financial life in order. Sit down, make a plan to get rid of all your bad debt and never ever accumulate it again. Because what bad debt means is this. It means, and some of you are not going to like this, you currently have a money management problem. You have a money management problem if you have bad debt. Now, I'm not a believer that you should destroy your charge cards. Do you need charge cards in today's society? Yeah, you cannot rent a hotel room or get a rental car without a charge card. You need charge cards. I'm a believer that you need to learn how to manage your money. So step number one, make a plan, get rid of that bad debt, and never ever accumulate it again. And then, as soon as you get rid of your bad debt, or while you're working on it, here's what I want you to do next. I want you to create more debt. But I don't want you to create bad debt, I want you to create good debt. What's good debt? Simple. It's the opposite of bad debt. Good debt means you are buying things that go up when you would borrow money. But here's the key. You are borrowing the money to buy things that go up, but they're going up faster than the cost of the money you borrow. Now, I'm telling you this because you were looking at a guy that got in real estate in 1981. Does anybody remember interest rates in the early 80s? FHA interest rates were 17%. Do you think a guy like me was borrowing money at 17% in 1981? What do you think? Yeah, but only if I could buy something that was going up 18, 19, or 20%. You see, it's not interest rates that you need to focus on. What you need to focus on is whenever you borrow money, what are you buying and is it going up faster than the cost of the interest at the time? Oh, and by the way, let me ask you this question. Is it relatively easy today to borrow money somewhere between 6 and 7%? Yeah. Relatively easy. Would you agree with that? 6, 7, 8. If you want to go to 8, I don't care. 6, 7, 8%. Relatively easy? Okay, now here's the next question. Is it relatively easy to buy something that's going up at 7, 8, 9%? Ooh, it's kind of calmed down there a little bit, didn't it? Okay, well, let me ask you this question. Let me go back a second. I want to take you back 3 years ago. 3 years ago, if I would have asked this question, is it relatively easy to borrow money at 6, 7%? What would you have said to me? Yeah. And then I would have said this. Is it relatively easy to buy something that's going up 7, 8% 3 years ago? What would you have said is doing that? Real estate. Okay, so then why did you pause when I asked that question today? Because the market is softer than it was 3 years ago, and you don't believe it's going to continue to go up at 7, 8%, right? But watch this. If the market is softer in real estate, does that mean sellers have a harder time selling? If sellers have a harder time selling, does that mean they're much more flexible to buyers who want to negotiate the price down? If I know what I'm doing and I'm an investor, is it possible that I could buy a property for less than its fair market value because nobody else is knocking on their door? Is it possible that I could buy it maybe for 8 to 9 to 10% less its value? You got this? In other words, a $200,000 property, I get it for $185, something like that. Is that possible? Okay, so now, is it possible for me to borrow money at 6 or 7%? Is it possible if I buy right to make a rate of return on that investment at 8 or 9%? Did you hear that? If I buy right, if I can get the property. So therefore, my question is this. If I know how to borrow money at 6 or 7, and I know how to make a rate of return at 8 or 9, if I know how to do that, how often should I be doing that? All the time, over and over and over again. You got this? That's how wealth is created.